Coming from a net loss position of 61.4 million shillings in 2008, you're certainly sounding optimistic about the 2009 period. What have been the major growth drivers for you?
Well, essentially the loss that we incurred in the year ended February 2009 was a result of the liquidation of two of our businesses in South Africa. We have taken the hit, and now all our business operating on a positive basis.
Well, it's certainly been a tough year despite that. I mean, we've had the company being put into liquidation. You've had to pull out of your South African operations as well. Just how much leaner an operation are we looking at the moment?
Well, taking South Africa, for example, we had 450 staff spread between Johannesburg and Cape Town. We have relaunched in the two business sectors that we were in, and we're operating with about 50 staff now. We expect turnovers to be, much lower than they were before, but we don't carry debt, and we expect the businesses to positively contribute to the bottom line.
So just how much bulking up should we be looking forward to now, and is it on a healthy enough balance sheet?
Our balance sheet is healthy. We carry minimal debt, and all our current businesses are positive cash generative. So we're quite bullish about the future, and we actually see that although it was painful, the process we went through allowed us to clean our group balance sheet.
In the past, the company had a lot of debt, used a lot of debt to actually fund its expansion into Africa, and the downturn proved that it wasn't really a sustainable business model. You've emphasized that you're riding on very little debt at the moment. How has your strategy changed so that it's more sustainable moving forward?
Traditionally, Olympia Capital has been debt averse, but when we went into South Africa with the acquisition of Plush Products and Matu in Johannesburg and Cape Town, we took on a lot of debt for operational purposes, essentially, because the levels of turnover we were achieving about 150 million rand in South Africa. To sustain that level of turnover, we carried a lot of debt in terms of discounting our debtors, in terms of overdrafts, etc. Now, with the recession in South Africa, that model was unsustainable. So when you look at our business in Botswana, you look at our business in Kenya, we don't carry debt. So really, I would say that what we did in South Africa was a deviation from our normal strategy, which we've gone back to now.
And taking that strategy across the region, looking at strategy, you've also migrated from the industrial and allied sector towards the financial and investment sector on the NSE. Take us through that development.
When we listed 34 years ago as Dunlop Kenya Limited, we were a vinyl tile manufacturing company. Over time, we have ventured into other lines of business. So we felt that remaining in the industrial and allied sector does not give a true perspective of what we are. We consider ourselves a venture capital firm that happens to be listed. So we wanted people who buy our stock on the Nairobi Stock Exchange to understand that we are an investment company, and that's why we migrated to the finance and investment sector.
You've also got quite a diversification strategy at play at the moment. Not only are you into buildings and building material supplies, but you ventured into real estate, so that arm is developing as well. But what's interesting is that you've made an acquisition in the food processing industry as well. Now, that's quite a divergence from what your core business has been. Do you see that as a potential risk moving forward? Some would say that you risk becoming too diverse as opposed to focusing on your core operations.
We want wallet share, and essentially we initially got wallet share by providing building materials. We then went into property where we are providing accommodative space in terms of residential and commercial. We feel that a natural way of getting bigger wallet share is to provide food to the populations in the countries where we're involved in. So the food is a future strategy. It's something that we're looking at. We're getting into it very cautiously, but we believe that that is an area of future growth.
What do you see driving bulk of your revenue growth in the short term, and do you see that swinging significantly as you move forward with now your long-term plans?
Our source of growth will be in the building material sector in the immediate term. I see that is where we will recover. We're installing a new plant in Kenya. We've managed to go back into Johannesburg with our brand name Yokota. We have managed to purchase our plant, the plant that we had in Cape Town, and we're back on stream. So I see that being the area of growth in the next, let's say, 12 months. After that, it'll be other areas, such as the food line that we're talking about.